Thanks for coming in. Let's concentrate on what is really front and centre right now, and that is, of course, what's going on in the eurozone. And we do have we had William Hague, the British Foreign Secretary, liken the eurozone as a burning house with no exits. But if it is that, why haven't we seen significant depreciation for it?
Well, I mean, at times it does seem like the euro is a burning house, as you know, as he said, with no exit. It hasn't really been a fruitful strategy for the most part to try to sell euro, particularly at the lows, when you have these extreme pessimistic moments. And I think likewise, it hasn't really paid off to buy euros at the highs when we've kind of gone into a very optimistic kind of mood for markets. I think the reality is we're really swinging back and forth. This is a very fast-moving story, and I think it's actually very hard to manage.
But there's very little good news. That's the whole thing. I mean, it's all bad news, really, at the end of the day.
Well, I mean, good news is basically the absence of bad news. So to the extent, you know, that the euro policymakers...
Which is less bad now, you know, you could argue, too, in the current environment.
Well, I mean, to the extent that the euro policymakers are, at some points in the past, have been convincing enough, you know, to lead us to believe that they have come up with this, quote-unquote, comprehensive solution, that has gotten markets into some kind of optimistic mode that was probably a bit unwarranted. I think we continue to be very volatile, but you know, within this sort of range until, you know, we have confirmation that things will be sustainably better.
What about the dollar itself? I mean, it continues to weaken against, well, apart from, of course, the BOJ's move earlier this week, which took everyone by surprise. But it is a weak currency. Is it? It's more than benign neglect. Do you think it's a deliberate policy of trying to devalue the currency?
Well, certainly with, you know, Obama wanting to double exports over the medium term, I think the U.S. wouldn't mind having a weaker dollar. Medium term, we are bearish the dollar. But again, I think the framework with which you should be looking at currencies is really risk on, risk off. Which are the currencies that are risk off? Which are the currencies that are risk on? And then just look at the next headline. That makes it very difficult to manage risk. So what our recommendations have been to investors are try to look at those small pockets which are a bit less correlated to this risk-on, risk-off paradigm.
So we're talking about a currency which doesn't even exist here, aren't you? Because we're talking about non-deliverable forwards for the yuan.
Well, okay, our recommendation has been for the renminbi. We have measured it to be less correlated with this risk-on, risk-off, therefore less exposed to headline risk. We have been putting on a recommendation to sell the one-month NDFs. You've seen, you know, the Chinese persistently fix the renminbi stronger. Today we had an all-time low in dollar renminbi, i.e. an all-time high in the China fixing. We think that sends a signal. So we like to be...
So it's just ratcheting slowly and very, very slowly towards its appreciation.
Well, given the massive volatility that we've seen in all other currency markets, I'd be pretty happy with a slowly ratcheting sort of currency. So,
okay, I want to move to some of the other currencies in this part of the world. What about the Aussie dollar? I mean, it's stubbornly above parity here.
Right.
It's 104 or thereabouts. It's taken a little bit of a move down. Where does it go?
Well, I mean, I think with the RBA having cut rates recently...
And the forecast today as well.
Right, exactly. I mean, from the macroeconomic point of view, we think that it's one and done. They're back to neutral. For the FX, however, we think that parity, above parity, is a bit too expensive. You know, with commodity prices coming off, with China slowing down into a soft landing, with the RBA no longer hiking, we think probably above parity is no longer justified. We're looking at 95, which we still think is a very strong level for the Aussie, but not the extreme of evaluations above parity that we've seen recently.
Right, what else are you looking at here as well, and you know, what would be your recommendation when it comes to all this? And also bear in mind that, you know, we're going to get back to the yuan because the G20 has been discussing yuan flexibility here as well. Probably will get that, but not for a couple of years, will we? Or longer?
Well, you know what? I would watch the G20 very carefully. You've had some headlines. Obviously, headlines over the last 24 hours dominated by Greece. But you actually last night had U.S. Treasury official Brainerd saying, you know, hinting that China may agree to be a bit more flexible with the renminbi as a result coming out of this G20 meeting. You've had Merkel supporting the idea that the renminbi gets into the SDR. I think the renminbi story may just well be the dark horse coming out of this G20 when we're all looking for something about Greece. Perhaps they have a surprise for us.
Yeah, maybe the rabbit comes out of the hat. Very quickly, how important will the non-farm payroll report, the unemployment report out of the US be today?
Yeah, I think this is probably one of the least important payroll reports that we've seen in some time. It's all about this vote of no confidence in Greece. It's all about the G20. I think from the Fed, from the U.S. economy perspective, The FOMC meeting this week really told us what we needed to know, which is that their forecast for the medium term still has unemployment very, very high. I don't think we should expect rates to go up anytime soon. So that's really all you need to know about the U.S. economy.
Yeah, 2013, I think, is what they've said already. Thanks a lot for that, Daniel Huida from HSBC.